In this week's video, for those of you that are tossing and turning at night, we'll review the latest charts and data to help us better understand a prudent strategy for Mag-7 concentration risk anxiety. Source of the data on your screen. Here's the X handle. The NASDAQ composite has been above its 100-day moving average for 8 months, 168 consecutive trading days. These are the signal dates from that research. This list is the same as this list here. And here, we wanted to ask and answer something that just happened on January 9th, 2026. Does it align with or contradict the secular trend thesis? Answer: it firmly aligns with it. Something that just occurred, a signal that was triggered on January 9th, 2026, historically, handful of dates over here. 4 years later, every single case, the S&P 500 was higher. The average gain was 63.88%. The median gain was a hair over 60%. Every case, the market was higher. 2 years later, 3 years later, and 4 years later. Firmly aligning with, rather than contradicting, the secular trend thesis. Also something that can help us control anxiety potentially later in the year when we experience 100% normal and to be expected drawdowns. The average maximum S&P 500 one-year drawdown following these signal dates was a hair over 4%. The median drawdown was 3.82%. We know the signal date, and we know where the S&P 500 closed on January 9th, 2026. Thus, we can get some idea of what is normal behavior within the context of the recent signal. Average and median drawdown relative to the signal dates right down here, around 6,700. This is the range of outcomes following these historical signal dates. We should also keep in mind drawdowns are a fact of life in the stock market. 94% of all years experience at least a 5% drawdown. 63% of all years, roughly a 10% drawdown, which tells us this type of drawdown, and even these maximum drawdowns, a hair under 10%, 100% normal and to be expected from a historical perspective. It's extremely important that we maintain realistic expectations about how markets operate in the real world. How about NASDAQ performance walking forward from these same signal dates? Also quite satisfying and aligning nicely with the secular trend thesis. In every single historical case, the NASDAQ composite was higher 4 years later. Average gain 75.07%. Telling us we don't want fear of this to be the enemy of capturing this. And as we all know, none of this predicts anything. It simply speaks to the probability of good things happening relative to the probability of bad things happening, looking out 1 to 5 years. Clients and regular viewers will recognize this chart. We've covered it numerous times in this window here. You can make an argument that this is a left shoulder, this is a head, this is a right shoulder, and this is a neckline. And conceptually, we know that harder markets, 2013, harder markets, 2016, harder markets, 2018. And remember, this is a relative chart, QQQ relative to SPY. So in this case, this is a harder market to be a QQQ investor relative to SPY. Harder markets are typically followed by easier markets. The longer a market goes sideways, the bigger the move we can expect to get. We either get a bullish breakout or a bearish breakdown. Here's your breakout, good things happen. Here's your breakout, good things happen. Here's your breakout, good things happen. Having said all of that, this is far from a convincing move thus far. And as we've mentioned in the past, our interpretation of this chart would change significantly if the ratio moves back down into this area below the upward sloping and somewhat flattening out 200-week moving average. If we look at the same ratio, the triple Qs, the NASDAQ 100 relative to SPY, on a monthly chart and put a 30-month moving average on it going back to 2009, can see this behavior in this window here is a little bit different from the strong trend look that dominated between 2009 and let's say 2020. Now at this point, nothing is particularly alarming on this chart dated January 15th, nor is anything particularly alarming on this chart with the 200-week moving average dated January 15th. As you might guess, there's a however coming. There are numerous charts that are starting to get a little bit concerning, at least on a relative basis. This is XLK, the tech sector for the S&P 500 relative to EUFN, European financial stocks. And in this case, we're looking at a monthly chart with the 30-month moving average. And technicians out there will know conceptually when you drop below the 30-month, price gets back above it, and then you have somewhat of a retest look. When you make this higher high right here from a probability perspective, this is an excellent entry point. And in this case, it worked out pretty well. If you entered right here, you got to ride this trend all the way to this point here. So let's take the same ratio and flip over to high-low close bars. This is starting to look concerning over here. Why is it concerning? To make an argument, this is almost the mirror image of this here. So we move above a flattish 30-month moving average here. We have a retest, and you can see intra-month we drop well below that 30-month moving average, and we rallied. So this is a breakout. This is a successful retest, kind of an overshoot look, and then a higher high. This is your buy point. If we jump back up to the upper right-hand portion of your screen, you can make an argument that if we make a lower low here, after we came up and failed at a declining 30-month moving average, if we make a lower low, that lower low from a bearish perspective would be similar to this higher high from a bullish perspective. Now that hasn't happened yet. And you can see intra-month, in many cases, things looked a lot worse during the month. This is where we closed. This is where we were during the tariff scare at the low. This is where we closed for the month. Similar situation here. Markets like to overshoot. It was pretty scary right here. And then the close for the ratio was way up here. And we can also see the fact that the 30-month moving average rolls over and prices below it is not that unusual. But if we're being objective, this looks worse here than this does here, and it's concerning, and it's something that we just need to keep an eye on from a leadership perspective. There's a gap here, and for the most part, this is a trading range. There's no clear winner in this window. You don't want to panic yet from a leadership perspective, but a breakdown and a close below this low here, and a close below the box, a close below this gap, all of that would be relevant and something that we just need to prepare for strategically, tactically, from a tax planning perspective, and from a psychological perspective. How would we handle it if it does break down? Also something that says we should take this seriously. If you look at the stack rank here in October of last year, there's a lot of tech near the top of the rankings, which told us we may be getting that bullish breakout here. Now we could be moving in this direction with conviction after we broke above this neckline. But thus far, that hasn't happened yet. That would be the bad news. The good news would be we're still above this point, still above this point, still above this point. We're really just consolidating. If you're a bull, you'd really like to see a higher high and a move into this direction here. So back to the weight of the evidence in the stack rank. In October, it looks good. It's deteriorated since then. If we look at it this week, XLK has moved from 39 in the stack rank down to 77. That's not a disaster considering SPY is at 111, and this stack rank goes all the way out past 350 ETFs. But the moral of the story here is the fact that XLK has been dropping in this stack rank tells us it's probably prudent to have a game plan for a potential breakdown. A breakdown that, I might add, has not occurred yet. Now, these are monthly charts. It's the middle of the month. This is the 15th. And this tweet from the 16th tells us that we should be open to two things. Either some of these charts that look a little bit concerning are going to rally between now and month end, and they'll look better, or we're about to get some trend flips from a leadership perspective. Now, this chart here is January 14th. We always talk about technical analysis being about subtle shifts in human behavior. Look at human behavior here from 2011 all the way here to Q4 of 2022. On a closing basis, the ratio of global stocks to global stocks ex the United States, so global relative to foreign, has for the most part closed above a rising 30-month moving average until the end of 2022, early 2023. So this is a sign of weakness here, and we're back below it as of January 15th. And I can't emphasize enough, that's intra-month. So we want to see where this closes at the end of the month. But right now we're below the 30-month, and you can see this has kind of a flattish look. This and this, they look different from everything going back to 2009, telling us to keep an open mind about something that's really good news, continuing broadening of the rally. This says, if you look at this list here, what's in it, that it's possible the days where SPY, XLK, and large cap growth ETFs are the place to be exclusively could be coming to an end. And that's not necessarily a bad thing, because that can help us with that concentration risk concern. But we don't want to jump the gun. You may remember from last week's video, we said we kind of covered the best of the best. So as far as foreign ETFs go, this is a leader. It's kind of ahead of the game. And it's also a specific sector, financials. It's not a broad sector ETF. So if we just look at the tech sector XLK relative to foreign stocks, a world index, removing the United States, which is what ACWX is, this looks fine. There's no trend flip here. We do see signs of a weakening trend. See all the white space between the ratio and the upward sloping 200-week moving average? This looks a little bit different. This looks even worse. And now we have a lower high relative to this high. And given this and this shift from October to here, we decided it was time to develop at least a strategy for potential trend flips. So what happens if this trend rolls over? The ratio goes below the upward sloping 200-week, and eventually the slope rolls over. Well, in advance, so we're not caught off guard, we want to strategically, psychologically, and tactically plan for a wide range of asset class leadership outcomes. And that includes potentially, if we have, thankfully, and fortunate enough to have it, big gains in our existing positions relative to our cost basis. How do we handle that from a tax planning perspective if the moves are made in taxable accounts? So we have slowly made a decision to take a baby step psychologically. It takes FOMO out of the equation. We took some profits on one of our tech ETFs. Not a lot, not a big move, relatively small move. Clients can look at the movement this week and see how small it was, but we diversified a little bit. Instead of having a chart that has kind of a tired, vulnerable look, or even a waning trend look, this chart has an emerging trend look. You have a consolidation box in XME, metals and mining, so these are stocks of metals and mining companies. Relative to the S&P 500, has been going sideways in a consolidation box since 2015. So basically a decade. And now it looks like it's trying to break out of that box. This is a weekly chart dated January 15th. XME was outperforming SPY by 6%, but the important thing was we came to the top of the box, were rejected, and instead of being firmly rejected, we went back and buyers stepped in above an upward sloping 200-week moving average. So if this breakout holds, the longer we go sideways, the bigger the move we can expect to get. So we felt it was time to be willing to take some profits in some of our tech ETFs and start planning for a future that might include broader participation from an asset class leadership perspective. Now, this is early here. We're just now breaking out of the box. We have some text here on the screen for clients if you want to pause your video player and read that to better understand our approach. We also took some capital and redeployed profits from large cap tech into a global AI and tech ETF. And if you look at the stakes, they're almost ridiculously small. Again, these are psychological first steps. Now that we own this, it tones down the fear of missing out. Now you can objectively compare XME and all of the ETFs that we're about to cover to what we already own. It just becomes easier. It's a way to deal with human bias and human weakness and make sure that we're thinking clearly and rationally rather than blindly and egotistically defending one sector or one type of trade. But at the same time, we don't want to move too quickly or abandon a trend that's clearly still up prematurely. So this is AIQ relative to SPY, and much like this chart that has an emerging leadership look, the look of this chart here, this is what SMH relative to SPY and XLK relative to SPY looked like really in the spring of 2023 after the major low in Q4 of 2022. And good things did happen after that. These AWOP lines tied to this peak right here and this low here, you can see there was a dogfight between the bulls and the bears and the ratio here. Now we're above all of those AWOP lines, including from this peak, and we're also above this area that once acted as support and then represented a waterfall breakdown look here. So the longer we can stay above these rising AWOP lines and above the dotted horizontal line, this is telling you from a probability perspective that this downtrend, the odds favor it being over. Favor, odds, probabilities, not certainties. So if the ratio moves into this area here, we would have to reassess those odds. Now, this is a chart that we covered a few weeks ago, and we said the same thing. This is a nice emerging look. So to take a small position in ITA enables us now to think clearly. Do we want to add to ITA or do we want to stop? Because the primary trends are still in place, and we're respecting that we could still get a break to the upside while preparing for the negative outcome from a leadership perspective. We don't care whether we take incremental step 2 or it's just incremental step 1. We'll see how things unfold and make decisions based on the evidence. It's possible this is just a continuation pattern where the market needs to consolidate its gains. It's also possible there's distribution taking place in here and we're going to roll over. So it's much easier to ride the leadership trends in this window and even here in this window. It's getting a little bit harder now to do it blindly with this vulnerability that we have here, at least until it's cleared up. And thus, given that we've got some subtle shifts in some of these other areas, other asset classes, other regions of the globe, other opportunities, including FNDF. This isn't a cap-weighted index. It's a fundamentally derived ETF. It chooses stocks based on fundamentals. So that helps us diversify on strategy relative to using something like an SPY or an XLK. And it's almost the opposite of the tired trend look. This is a strong downtrend here with white space between the moving average and the ratio. This is a trend that looks like it's trying to strengthen. This looks different from this back here, and this looks different from this. Why? Because now you're above the 200-week moving average and it has a flattish type look, whereas here it was still clearly downward sloping. Also important, remember in early videos we said this was somewhat like max tariff fear here, and we had never exceeded this high. Well, that's not true here. Now we've exceeded this high. This is the April low here where the tariff news became less bad. Now we've consolidated these gains and made a higher high. And we have printed a higher high on a weekly chart. There are closes in this region here above this point here, telling us the odds of this moving in this direction are higher than they were, let's say, here. Now, having said all that, there's a lot of resistance in this area here, potentially, if we drew horizontal lines. And that's one of the reasons why you take a baby step, an almost ridiculously small step. You never take step 2 if we can't clear these levels and this can't turn up. It gives us some different exposure from a sector perspective, and it also gives us some different exposure in terms of capitalization. And in this case, more a style consideration. Rather than being up here firmly in the growth category, this has more of a value or fundamental type orientation and a much, much broader distribution between sectors. Now notice, this isn't blind diversification. There's evidence that things could potentially be changing here. This looks different from anything that we could see down here. And this looks better than anything that we could see in this region here, dating back to this October low. And this is the first time that we're above this box in almost a decade. Thus, this look on the upper right-hand corner here, or the midpoint of the screen on the right side, fits in with the data-driven approach. We can see this, measure it, and put it in a model. We've been patient enough to see if the odds have improved that we're going to break out of this box. It doesn't mean we're going to break out of the box, but this definitely looks better than anything back in this window here. Same can be said here. It's just a different take on the AI trade. A little blurb on some of the objectives here. You can see DTCR, Global Data Center and Digital Infrastructure, relative to SPY, is now above what is still a downward sloping 200 week, but you can see the slope does look like it's trying to flatten out a little bit. So we went above, this is somewhat of a retest, and now we're trying to print a higher high above the 200 week. We're also breaking out of a consolidation box here that dates back to May of 2023, telling us the probability of DTCR outperforming has improved. And notice we use the term probability, which is significantly different from the term certainty. It also allows us to address that tossing and turning at night about the concentration risk. And that too is based on facts. Easy to stay with this trend in here, getting a little harder here, a little harder again. And the fact that this is a lower high relative to this high makes it a little harder. And the fact that this list looked like tech was back in business, and now it's starting to fall, telling us it's possible that we're getting distribution in this area. All of that is relevant. It's also relevant that this ratio is still well above the 200-week moving average and still above this neckline. Hence, the small incremental moves, not an overreaction. If this breaks out in this direction here, that would be great. Life gets a lot easier for us. We need to have a game plan for both outcomes. Now back to DTCR. It also gives us some non-US exposure. And you can see here the capitalization is not pegged up into this style box here where it's 100% large cap growth. It gives us some diversification, trending more towards the value end of the spectrum and more towards the mid-cap end of the spectrum relative to most of the Mag-7 dominated ETFs that were leading since the October 2022 low in the S&P 500. DTCR also helps us in terms of sector diversification, and we're not diversifying for the sake of diversifying. We're diversifying because of the improvement in the trend. And we don't necessarily need DTCR to overtake XLK. It's really SPY that we're concerned about, trying to find pockets in the market that have a chance to outperform the market. Now, this box here relates to some of the fundamental research that we've been conducting in recent weeks. And it's noteworthy. If we look at the Magnificent 7 relative to the S&P 500 without the Magnificent 7, so the other 493, yes, it's been underperforming in here, but what once acted as resistance, what once acted as a stall area, may now act as support. There's really not anything alarming yet, even on a shorter term time frame. We still have some reference points here. We also want to maintain realistic expectations about how markets typically act in a midterm election year. We have midterms coming up. This is mid-April here. This is September here. This type of potential drawdown aligns with the numbers here on your screen. And if you can see where we would potentially go back to, this type of drawdown hypothetically doesn't put the secular trend in jeopardy at all. This is where the rising 200 week is. If we follow a similar drawdown path, our drawdown would be between this point and this point hypothetically, with the highest probability point being in here. So maybe a give back to 6,700 later in the year. Here's the signal. Here's the source of the data on your screen. This is an X handle here. Something similar has happened in the past. The S&P 500 was higher a year later in every single historical case, with an average gain of almost 19% and relatively muted one-year drawdown of approximately 8%, telling us to keep an open mind about better than expected longer-term outcomes within the context of 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends. This too would tell us it's possible that 60 trading days out or so that we could come back to roughly where we are now. And if we follow a similar path relative to these cases here, 250 trading days out, good things from a probability perspective could happen. This reflects this number down here based on these historical returns after similar historical signals. This is the chart that we covered in the December 18th video. We're looking at a Mag-7 heavy ETF relative to one that only has about 2% exposure. You can see the uptrend is still intact. If we fast forward to January 16th, 2026, as of the close, you can see we're still well above the rising moving averages. What once acted as resistance, may now act as support. That coincides for the most part with those rising moving averages. So thus far, haven't seen anything in here that's particularly alarming from a long-term trend perspective. A similar situation here. This is MGK, mega cap growth, heavy Mag-7 exposure, still clearly above an upward sloping 200-week moving average relative to foreign stocks. As pointed out by our friends on Twitter, if you're concerned about concentration in the United States, it's worse in China, South Korea, France, Brazil, and Germany. We live in a capitalization-weighted index world, and if you pause your video player here, it's not unusual for a handful of stocks, somewhere between, let's say, 5 and 50, to dominate the performance in the S&P 500, the Dow, and the NASDAQ. It's not abnormal, it's normal. But we still need to keep an open mind, take it day by day. This is during the session on January 16th. XLK relative to IWM checking 100% of the bullish boxes, tech relative to small caps on the monthly cloud. Do we want to dump all our tech and buy more XLF? We do not. XLK relative to XLF checking 100% of the bullish boxes as of January 16th on the monthly cloud. And if you're a client and you've been worried whether we were going to blindly stay with the current leadership forever, the answer is no. The market will determine whether there's an incremental step 2 or we stop and hold what we have after incremental baby step 1. And we all know The only way that we're going to be able to make those decisions effectively in the coming weeks is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.